Hello, I'm Merv Hecht with Double Your Yield, and it's December 19th, and I'm here to tell you what I've been doing for the week and plan to do for the coming week. This week, I'm really heavily focused on oil stocks and stocks related to the oil industry. My vision is that there has been a unreasonable, psychologically based drop in oil stocks, and I feel very confident that they'll go back up, but I'm not saying when. The big advantage in oil stocks at this point in time is that it doesn't really matter so much when, because the yields are so high. Take, for example, Transocean, the symbol for which is RIG, R-I-G. Transocean has dropped in the past year from 50 to 16 and a half. Now, the disadvantage of the company is it doesn't operate currently at a profit, but it has a yield at 17%. Now, I expect that yield to be cut in time, but even when it's cut, I expect it to be substantially more than I can get buying other stocks. And so with a good yield, I can afford to hold the stock for quite a while. What I've done is, instead of buying my usual allocation, I usually would buy 1,000 shares of a stock in this price range. But what I'm doing here to lower my cost is I'm buying 500 shares for the yield, and I'm selling a put. In this case, I would sell the 15 put and collect in $2.60 a share, lowering my cost to about $15 a share. If I have a problem with margins, I would hedge the naked put by creating a put spread by buying the May 11 puts, which are less than $1. That reduces the premium that I get from the puts, but still reduces my cost of the stock. And I don't mind if I get put the other 500 shares, because I would normally buy 1,000 shares anyway. I'm just being extra conservative in a market where these stocks are dropping so much. The other stock I'm doing similar purchases with is Noble, and you might want to take a look at that. The advantage there is that Noble is still operating at a profit. Good luck. See you next week.